Hey guys, Rob Petrie here with Hub International here in Sacramento. Hey, today I want to talk to you about a situation that many employers face, something that I've seen a lot over the last 20 years, and that is having two insurance carriers for your medical insurance with similar plan designs, but with very different rates, very different premiums. And it's a situation that becomes a problem because oftentimes one carrier is in what we call adverse selection, a death spiral, and their rates are just going up drastically quick, and they get to the situation where there's very few employees left on their plan and they terminate their coverage, or the employer just drops them because it's not a realistic alternative any longer. And oftentimes employers are baffled as to why that actually occurs. But it's very foreseeable. And if you take the steps to prevent it, you really can. So let me share with you how this actually happens. So I'll just give you a hypothetical scenario, but it's actually a scenario that I've had several clients that have hired me that they were in this situation and we had to fix it. So let's say that you had a $300 premium a few years ago, and with Carrier A, and the employer was contributing 90% of the employee-only rate, and the employees were paying for 10%. So effectively, the company was paying $270, and the employee was paying $30. That employer decides to bring on a second carrier. And that second carrier, let's say, is very aggressive with their underwriting, and they come out at a $270 premium. Now that employer says, well, okay, I'm already contributing $270 to Plan A. I'm just going to contribute the same amount to Plan B. Therefore, Plan A, it's costing the employees $30 a month. Plan B is free. So we get to the renewal, and what happens? The young and healthy employees all go to the free plan, and the older employees or the employees with more medical conditions stay with Plan A. They don't want to change their providers, they don't want to change their coverage, so they stay with that. So what happens at the first renewal? And now I think you're starting to see it. Carrier A says, wow, what happened to the risk that we had? Now our average age has went up considerably, and we have to give you a 15% renewal. Carrier B says, wow, the demographics that we have are a lot better than what we even quoted originally, so we're just going to give a 5% increase, or maybe zero. So what happens is each year this occurs, and what happens is that original carrier, Carrier A, they end up in a situation where their rates are considerably more than that second carrier that came in. Again, I've had clients that for similar plan design with carriers that generally have pretty similar rates, and one carrier is charging $150 more, and it's just a function of demographics. So what can you do as an employer? Well, you really have to pay attention to the rates and what you set as the employee contribution. If you want to maintain two carriers over a long period of time, then you really need to have a contribution requirement out of those employees that is very similar, if not the same, for the two carriers. Oftentimes, if you end up in a situation where there's a great deal of disparity between the two carriers, you can work with the carrier with the very high rates, the carrier that's in that death spiral, to really fix that situation and right that ship. I've had great experience righting that ship. It doesn't happen overnight. What takes several years to become a problem takes typically several years to fix. But with commitment from the insurance carrier and from the employer, it can be fixed. You just really need to be cognizant of those contributions and set up a strategy that is for the long term. Hope this helps. If you have any questions, shoot me a message, and hope you have a great day. Thanks.